Good evening, everyone. My name is Deepa Rao. I'm the current president of AAIWO. Let me go through the mission and vision statements of AAIWO. Let me share my screen. Can you see my screen?
Yes.
AAIWO is a 501c3 nonprofit organization for Asian Indian women promoting professional development and education through scholarship and cultural outreach programs. AAIWO is an organization that is committed to helping women in need. Our helpline phone number provides women in crisis free professional help from qualified consultants. Calls are received from women in situations of domestic abuse or women confused about immigration status or career changes. They receive information about their options and rights, which helps them to make decisions about their lives and future. All calls and information obtained are strictly confidential. The helpline has played a pivotal role in helping women changing their lives for the better. Over the years, it has helped many women in situations of domestic abuse, financial distress, and navigating immigration law changes. If you are someone you know as a victim of domestic violence or being subjected to abusive tactics of power control, please call us at AWO Helpline at 440-218-6965. Someone will get in touch with you within 24 hours. Your call is strictly confidential. Once again, the hotline number is 440-218-6965. Now over to Mahima.
Thank you, Deepa. I welcome all of you to this wonderful session. We have Lori Kaplan with us. She's a wonderful friend and a financial advisor, and she has helped many people in various aspects. Lori has been celebrating her 30th year in financial services. Most recently, in the last 3 years, she became a Geauga County resident, and she's spending her time meeting residents and building relationship with other business owners like herself. She helps individuals and businesses strategize and update their financial legacy using insurance and security products. Clients also call on her to think through the plan and how they can protect their assets, build wealth, plan for college, retirement, or any long-term goals that they have. She usually helps them structure their business successions as well and fund their estates. She offers various financial planning and full line of annuity, disability, and long-term care insurance products. So I welcome Lori Kaplan to give us a wonderful workshop today on financial knowledge. Hey, Lori, welcome to our group, and we are glad to have you with us this evening.
Thank you, Mahima, and thank you, Deepa, for having me. I'm honored to speak to your organization. Your mission is so wonderful. However, I want to focus on why we're here. So I'm going to load my PowerPoint now, and we'll get started. If anyone has any questions, please put them in the chat, and Mahima or Deepa will coordinate those. Okay, I am the host now, so let's share the screen. So we're going to start by creating financial independence. This is a Women for Women. Women are a very important part. I just have to move you all around. Women are a very important part of our society and do quite a bit. Why aren't we moving? I'll just move it over here. So I'm welcoming you. Mahima gave a great bio. I've been in the industry for 30 years. You did forget to mention life insurance, Mahima, but that's okay. I'm mentioning it now. This is my information. I think we've emailed many of you the workbook, which you can work through as we work through this, because I'm unclear of where everyone is in their stages of life. Some may be very basic for people. Others may be new. This may be new information. And for others, it just confirms that you're on the right path. Our disclosure statement, I just breezed past that. Today's agenda is really to provide information to help you understand your current needs and empower you to make informed financial decisions. We have a number of different slides, and we're going to start. First, we have the workbook. We emailed that workbook to you yesterday, and so please access that. So let's just dive in and talk about women. Women are in control. We make up and generate over $1.9 trillion in revenue in the United States and represent 42% of all business owners. And that number is growing. So we actually can lean in and have financial power and prowess. 62% of all women say they feel empowered when they are comfortable about their financial situation. I work with a number of business owners that are women, and I also work with a number of families or individuals. And knowledge is power. We know that. And the more informed you are, the better educated decisions and comfort you will have. And in 2030, which is just 6 years away, we are estimated to control 31.8 trillion in buying power and influence 89% of all household spending. We influence quite a bit right now, but we will be influencing more. So how do we help you protect your standard of living? Wherever you are in your stages, you're always pushing something up a mountain or up a pyramid. You could be down here in this charity area, which I doubt you are. Bare necessities, you could be getting by. You could be moving from getting by to feeling comfortable over that hump to luxury. While you're trying to push yourself up the mountain, everything is trying to push the ball down the mountain. There are taxes, there's inflation. We have just come off a high inflationary period that has impacted the purchasing power of many people and many families. There's death, there's disability, and retirement. And so you're going up to luxury, comfort and luxury, and all these factors are pushing you down. So what a good financial advisor, somebody that works with you does, is they help put that stop gap in there. And that stop gap keeps you from falling down the mountain by making sure you have the correct products, both in the insurance and investment arena, and that you have your plan intact. And you have so much going on. We have so much going on. There are, at the beginning, you're having a job and you're working a job. Then you're getting married. Then you have kids. Then your kids have activities. Then even if you don't, I mean, there's always something. And it's so hard to push things to the side. We'll just take care of it later. But then when later comes, it's like, oh my gosh, I've missed 10 or 15 or 20 years that I could have been accumulating. So we want to address that. That's what tonight's about. So where do you begin? We begin with financial goals, and then we go on to risk management, investment strategies, retirement planning, and estate planning. And that's what we're going to be talking about. Financial goals to me are it's like dieting. If you go full out on a diet, after 2 or 3 weeks, you're going to binge. It's the same with financial goals. The goals need to be specific and manageable. They need to be realistic. If you're not saving anything and you need to save something, don't say you'll save 1,000 or 500 or 250 a month. You're not doing that. Maybe you start saving $50 a month. Maybe we then move it up to 100. You can put extra zeros depending on where you're at, but it's just slowly getting that savings going. It's slowly getting that money invested in a Roth IRA, or slowly getting that money into a 401k through your company, at least doing up to the match. And we can talk about that later. We really want to focus on money or on the task, and the task needs to be manageable. We want to establish an emergency fund. Every family should have at least 3 to 6 months of expenses sitting somewhere safe and boring, not earning a lot of interest, but being really liquid, so that you don't have to rack up credit card debt if you have to replace the hot water heater, or you have a car expense, or something even more major than that. So you want to make sure that you can get your hands on it, and you want to make sure that it's there. And it's there for an emergency. And because it's there for an emergency, we don't usually invest it. Because if the market goes down and then you need it, it's a bad situation. Credit, you want to control your credit cards, you want to check your history. I mean, with scams and people out there all the time that can hack in and identity theft, you always want to make sure that your credit is where it needs to be, or check your credit rating, and you want to control the use of your credit cards. So there are two types of people. And you can answer which one you are. You don't have to raise your hand, but you can certainly think about this on the next slide. So when we look at net worth is assets minus liabilities. So on page 2 of the workbook, I think we've got some factors on how to figure that out and what's considered going into your net worth. What do you have in savings? What do you have in investments? What do you have in your 401k? You know, we could put the house in there. We usually don't like to, but people do. But then you can subtract your liabilities. What do you owe on the house? Do you have credit card debt? Do you have student loan debt? You know, what are you paying off? And you do the assets, you do it minus liabilities, simple math, and that tells you what your net worth is. And what your net worth is when you're younger is usually not as much as what it is when it's older, because you work towards that. The other half of it is cash flow. How much money do you have every month? I bring in X and I spend Y, and this is how much I have left over. And so we always look at income minus expenses. Another word for that is budgeting. And budgeting is a dirty word. People don't like to do it. I have found we have some great wealth accumulation modeling that help people with that. You can get a budget form off the internet. You can download one. And just to track, you can just use, some people use an Excel spreadsheet, some people use a legal pad, depends who you are and what you're comfortable with. This is how much I bring in, and these are all my expenses, and this is what I have left. Two types of people. We have people that spend first and save last, and then we also have people that save first and spend last. So I was meeting with a couple last week. They are in their mid-40s. They spend first and save last. And so they're trying to build up their emergency fund, and they need a lot more money. And they just sat there and had this big aha moment during our meeting when we were talking about it. They said, well, maybe we should put money in the savings account first and then just spend what's left. And that's ideal. And that is, if you're not doing that, that's something that you can certainly try to shift over to that type of mindset, where put $100 away or put 1,000 away, whatever your number is. You put that away, and then the balance is what you can spend that month. So that is more where we win-win, doing the save first, spend last. Now, a lot of people save first by putting money into their 401ks at work, or putting them, if they own a business, into their retirement plans. Or if they're doing their 401k, they may also put money into a Roth IRA or a traditional IRA for retirement. But remember, you need to have liquidity also, and saving everything for retirement does not help with liquidity. But the discipline of saving first is there. And I have had clients that are excellent savers. They just don't save correctly in terms of the flexibility they need with and access to dollars. People have needs and wants. When you look at your needs, the needs are your basic expenses. It's going to be your mortgage or your rent. It's going to be covering if you owe money on a car. It's going to be student loans. It's going to be electricity, gas, utilities, telephone, anything that you need, food, food and shelter, anything that you need to keep your life going. It's not because you want to buy the couch. It's not because you want to go on the vacation. Those are wants. Those are not needs. Needs are what we need to make sure we can stay in our homes and have food, clothing, and shelter over us. And then the wants are the bonuses. And the goal is to be able to have fun with your wants. So what do we need to do to get you to that point? So if you go to page 2 in that workbook, where are you? Where are you? I'm not asking anyone to volunteer unless they want to. But where are you on your current savings? If we're looking at 3 to 6 months of expenses, not income. So if your expenses are $5,000 a month, then you need to have 15 to 30,000. It's very simple. If your expenses are $3,000 a month, 3 times 6 is 18. You need $9,000 to $18,000. As I said earlier, it's not going to happen overnight. You just can, we slowly make it manageable so that you should slowly make it manageable so that you can get there. And then an emergency happens, it brings you down, but you have the money to pay for it, and then you build it back up, and you just keep going back and forth that way. When we talk about risk, so that those are financial goals, and now we're going to move on to risk management. Risk management is boring. I just, there's nothing fun about it. It is just what we need to build a strong foundation. You build a strong foundation in the house, they dig it, they level it, they plant they use the concrete, pour the concrete, make it strong and stable so the house doesn't fall down. That's what risk management is. It's not talking about the fun stuff like the Dow hit 40,000 today for a quick minute. That's not what risk management is. Risk management are your insurances. They're life insurance, health insurance, disability, long-term care, auto, and home. And I tell people, I have had people that I have met with over my decades of doing this, that they have a lot of money in investments, they have a lot of money here, there, and everywhere else, but they don't have that foundation. And when you don't have a foundation and an emergency happens, all of a sudden they're taking all this money out of their 401k. They're pulling money from everywhere because they don't have that base put together. So let's look at the base. The emergency fund we have talked about. There are many types of life insurance, but it falls in two different silos. One silo is through your employer, which is called group insurance. So if you have an employer that offers this as an employee benefit, there's usually no underwriting. It's usually employer owned. The employer may pay all or part of the premium. It's usually group term insurance. Coverage can change. If I'm an employer with 10 employees or 20 or 50 or 100 or 5, and I decide to change my employee benefit package, and you had 2 to 3 times salary, all of a sudden you may only have 1 time salary because I changed the benefit as an owner. So there's no control on your part. It usually terminates when employment ends, though there are some employers that allow it to be portable and allow you to roll it out. And that helps, especially if you have some condition that makes you uninsurable, and this is the only life insurance that you have. And I have clients in that position. And it can provide basic coverage, and sometimes that's all it provides. With other larger employers, it can provide more. On the other silo is personal insurance. That's what you own outside your employer. It usually requires underwriting. Underwriting has changed over the years in terms of our access to information makes it easier for carriers to streamline the underwriting process so it doesn't put that much hardship on people trying to buy insurance. Unless you have multiple medical issues, and then we're out there getting medical records, but it's usually personally owned. You're usually responsible for the premium. It could be permanent and term, or term, and I have people that have only one and people that have both. And within the permanent space, there are different types of permanent, whether it's whole life or universal life or variable universal life. And then term insurance would be a 10-year, a 1-year term, 10, 15, 20, 30. It depends. The owner controls the changes. It usually remains in force as long as you pay the premiums, and it can supplement your group coverage. And if you no longer work for that company, you don't have to worry about losing your insurance. How much do you need? That's what people always ask. Well, how much life insurance do I need? And I always tell people that it depends. And I know that that's not a great answer, but generally the rule of thumb is at least 7 times your annual gross income. So if you make 50,000, that's 350. If you make 100,000, that's 700,000. 7 times 7, it's 490. Sorry about that. I've always told clients if they don't want me to figure out the calculation, it's usually 10 to 12 times. Usually works. Whenever I do the calculation, it always comes out at 10 to 12 times. But you also subtract what other assets you have. People don't usually like to count depleting their retirement accounts if they pass away for their surviving spouse or their children. They don't want that. You know, I mean, there's all different ways to figure it out, or people have legacy needs. People want their name on a building, or people want to make sure that they can leave money to a charitable organization. They're all, so no, there's no right answer and there's no cookie cutter response to that. It's individualistic, but we do have rules of thumb. And we also look at people's earning potential. We add up, skipped to add. We add up needs like funeral, childcare, mortgage, paying off debts, etc. We subtract the assets that you may have available, and then the difference usually represents how much life insurance you need. I just had a situation. I was with a widow yesterday. She was 40 years old. Her husband passed away very quickly when he was diagnosed. He was diagnosed with cancer. And then what ended up happening was he just didn't leave her enough life insurance. However, when I met with him 5 years ago, based on what his income was, he did have, and based on what we were trying to do back then, he did have enough. People get busy, right? Where does the time go? We talked about that. So every time I would reach out to him, let's revisit this, he was always too busy. And he was so busy that he passed away, leaving her in a not a good situation. And you don't want to do that, or you don't want, I mean, or maybe you do, but anyway, you don't really want to do that. You want to make sure that you're able to take care of your loved ones. So her life moving forward is a little bit more stressful than it would have been had he had that additional life insurance. When we started, he was making $75,000 a year. When he passed away, they were living $200,000 lifestyle. So we did, and so it just doesn't cover it. Life is based on earning potential. Samuel Hubner, who I studied in the 90s when I was getting my first advanced designation, my chartered life underwriter designation, always talked about how do you figure out how do you figure out how much life insurance you need? And it's usually the net present value of the future value of your earnings. And so when I'm a widow, when my husband became ill, he was upset about the amount of life insurance that he had. And I became a widow in my 40s also. I wasn't concerned because I just said, well, we're fine because we have the net present value. We had enough. We have enough. I can make this work. And we have, and my children were able to go to college, right? We were able to keep everything. I mean, everything that he promised to do with us, we were able to do without him because he had enough. And I wasn't concerned financially. Life is based on earning potential. So if you're 35 years old and you make $4,000 a month to age 65, assuming 5%, you'll probably be making about $3.4 million over your lifetime. Very simple. Does that mean you need $3.4 million worth of life insurance? Maybe, maybe not. We figure that out. And then what you do is you figure that out, you purchase to where you are now, maybe a little bit more, but then you continue to meet and make sure that you stay current. And that's the mistake my one client's spouse made. He just did not continue to increase as his earning potential, or as his earnings increased. If you want to take a snapshot of this, you can. I'll leave it up for a moment.
Lori, sorry to, we are getting some questions, and it kind of relevant to what you're talking about. So you did mention that saving up for retirement. So in your chart you did share that there are taxes and other implications as your potential goes up to have a good lifestyle. So one of our attendees is asking, taking out money from the retirement plans, are there any way to avoid taxes?
So a couple of things have happened. There really isn't. I mean, when you're taking money out of a retirement plan, if you're working and your retirement plan allows for hardship withdrawals or non-hardship withdrawals, if you're taking it from one retirement plan to another, there's no tax implication. But if you're actually taking it out and putting it in your checking account to spend, that's taxable income at your current tax rate. There is really, I have clients that do Roth conversions, even though we're jumping ahead. But you have to pay tax then. So if I took 100,000, let's say, or 50,000 out of a retirement account, and I did a Roth conversion, so now I have a $50,000 Roth IRA, which is non-taxable in the future. I have to pay tax on that today, or in this tax year in 2024. That's taxable income. So depending on what my income is, that could boost me into a different tax bracket. And then I have to pay more taxes, or can keep me in the same tax bracket, but I have to pay taxes on that.
Yeah, thank you. I think we can take more questions once you are done with your presentation.
Oh, that's fine. Okay. There's health insurance. There's disability insurance. Disability is when you're sick and hurt, you can't work. We always say disability insurance is the selfish insurance because it's taking care of you. Life insurance takes care of your family. I've had clients in their 30s and 40s that I've written individual disability policies on that have actually triggered and used them. Studies show that 1 in 4, it's the same statistic as it was 30 years ago. 1 out of 4 of us will become disabled. So I thought I saw there were 6 or 7 of us on this call. So 1 to 2 of us will become disabled during our lifetime, during our working lifetime. Money needs to come into your house. When my husband became ill, he had disability, he had group disability through his employer, and that helped us for the 6 months he was with us until he passed away. I have other clients that are self-employed that have individual disability insurance that helped them until they were able to go back to the workplace and go back and earn money. Long-term care insurance, depending on where the age bracket is with the people that are on here. Long-term care insurance is big. 70% of us that are over 65 are going to need it. I walk and talk it every day now, it seems. Long-term care is not going into a long-term care facility. It's having home health aid. It's paying to have somebody come to your house to help you. It's paying to go in adult daycare, assisted living, memory care. My father was in memory care. He had long-term care insurance and it helped pay for it. So it doesn't mean that you're going into facility care. The contracts that we have today are much more user-friendly. And a lot of the contracts today allow for family members, other than the spouse that's living with you, to take care of you and receive a stipend. So they're much more user-friendly than they were 20 and 30 years ago when I first started. So what is covered by Medicare and Medicaid? So people will say, well, I'm on Medicare. Well, that's great. Medicare really covers for acute illnesses. Medicaid is when you're indigent and you're on a program. They have specific rules about what's covered, how long you can receive the benefits, whether you qualify for the benefits, and how much you have to pay out of pocket. But it's really more for acute coverage, whereas long-term care insurance is for chronic, a long-term care event is a chronic need. It's designed to cover long-term. I already covered this. You can select a range of care options, and everything is usually customized. There are different options, and the options today are much more flexible and user-friendly than they used to be.
Yeah, Lori, we got another question from one of our attendees. Does long-term care cover unlimited time or just 60 months? It's coming from the information you told us like a couple of slides ago.
Okay, so long-term care insurance creates a pool of money. So 20 and 30 years ago, yes, it was unlimited. I have lots of clients that have these golden plans that when they need it, when they can't do 2 of the 6 activities or they're cognitively impaired and they trigger their long-term care contract, it can go as long as they do. Those plans have gone by the wayside because they were too hard for companies to manage that risk amount and keep that amount of money in reserve to pay a claim. The new contracts now go anywhere from 2 years to 7 years. So that doesn't mean you have the contract for 2 years. That means when you trigger the contract, you have a pool of money that can last, depending on what you choose, anywhere from 2 to 7 years. So and that's been an industry shift, and that has helped companies manage risk. The carriers that were in the long-term care industry 20 plus years ago, a lot of them are no longer in the industry, and they've had to stop selling the product because it was not financially viable for the carrier.
So we have another question. So they are asking, do we have to go through screening to be eligible for long-term care? So
Yes. The short answer is yes. It's medical underwriting. We do a lot of pre-screening when I'm working with someone who's interested in long-term care insurance. We ask a litany of questions. We check with underwriters. I check with underwriters with various companies just to figure out what's the right fit, because some carriers may not take a risk, other carriers are fine with the risk. So, and maybe all carriers will take the risks depending on what your health status is, but it is underwritten.
yeah, thank you. I think people are responding to some of the information that you are talking to us. So that's good.
And I have a lot of this type of information to share.
Wonderful.
Let's go to investments. Everybody wants to talk about investments because, like, the Dow hit 40 today. It's a little bit under 40 right now. Wow. So is it a good time to buy or is it a good time to sell? Anyway, investment strategies. When we sit down with someone that wants to talk about investments, you know, we've got that base done. We're moving up the ladder, we're moving up that pyramid, and now we're starting to work in the market. If you want high risk, you could get high potential return. You can also have a higher downside or lower downside. Low risk will have low potential return. So how do we figure out what your risk tolerance is? That's easy. We ask a lot of questions. We get a feeling. We could have 5 people sitting there or 3 people all the same age with the same amount of money, but they all have different risk tolerances. So their strategies will be different. So it's not as before, it's not a one size fits all. And it's based on what the use of that savings is, so that investment's supposed to be for. Is it for something long term? Is it just 10 years out? Is it this? Is it that? Whatever it is. So that also helps dictate that time horizon. We look at your investment objective. What's it for? What's your time horizon? Do you need access? That's important. I had someone that we were going to take a big chunk of money and put it somewhere and earn this great rate of return. It was fixed. It was in a fixed deferred annuity. She was the right age. It was the perfect use for that money. And at the 11th hour, she said, but next year we want to buy a condo. So so she needed liquidity. So what we were proposing to do made absolutely no sense. So we looked at a different option for savings, that she had 100% liquidity, that it was secure, and that she would be able to have access to it when she needed it. We also want to know, do you need the money, or is this money that you can afford to save and have a long-term horizon with? And will it change my standard of living if I lose some of it? Very important. We also, I mean, just going back to that, just for a minute, my world is highly regulated. And so and I'm a fiduciary as a financial advisor. So when we're looking at putting someone in an investment strategy, et cetera, it really is not only what I'm suggesting, but I have a team behind me making sure that it's a good fit for who I'm working with. So it's a second layer of protection. So now we're moving on to retirement planning. Calculate the cost of retirement. How much do you need? Set up a disciplined approach. That's in your accumulation years. You know, you're saving. Now you're getting ready for retirement. And you're like, what am I supposed to do now? And so what we usually do is we talk about retirement in 3 stages. We talk about it as the first 10 years or your go-go years, your second 10 years or your slow-go years, and then you go to your no-go years. And in your go-go years, you've just retired, you're younger, you've got energy, you've got health, you're traveling. You may not see such a difference in the amount of money that you need. It may be very similar or not that much, not that much different than what you were earning because of the way you live your lifestyle. The second stage, you're slowing down, you're not moving as much, maybe a couple of health issues, there may be a reduction in how much you need, it may be increased by medical bills. And then your third stage is your no-go years, like my aunt who's 97, where you're not traveling and maybe your health has taken a turn or your health hasn't taken a turn, but you're more sedentary. So how do you plan for that when we don't know how long you're going to live? So we figure it out. And a lot of it starts with how much you have to work with. We look at the sources of retirement income. There's Social Security. And yes, there still is Social Security. We do know that there may be some changes in 2034, there may not. We don't know. There are employer-sponsored plans like 401ks and 403bs in the nonprofit sector, simple IRAs, pensions, SEPs for self-employed. There's personal savings such as IRAs and IRAs could be Roth, could be traditional. Annuities, stocks, mutual fund savings, CDs, and I know a lot of people like to buy commodities like gold. So that's also there, but we don't have it on the slide. And this is in page 4 of your workbook. Those are the sources of retirement income. And what does that equal? So let's look.
Hey, Lori. I've got a question from one of our viewers. They are asking, can you expand on what is Roth IRA and a regular IRA and 401k?
Sure. Let's start with the 401k because it's a standalone. When you work for an employer can provide a benefit, a retirement plan as a benefit, and it's a savings. It's you put money into the market, you take a percentage of your earnings. It could be 3%, 5%, 10%, 15%, and that goes into pre-tax dollars unless it's a Roth 401k. But we'll talk about the Roth 401. When I talk about a Roth IRA, we'll talk about the Roth 401k. So 401k is a pre-tax, it's savings for retirement, and it's an employer plan. And the employer typically has a match. Some employers do dollar for dollar up to 3%, up to 5%, whatever the case is. So that means if you put 5% in and your employer puts 5% in, you already have 100% gain. And then that money is in the market, and depending on your risk tolerance, time horizon, and all those factors, that dictates how you're investing that money and what type of funds that are offered in that 401k, and then how they grow during your working years. The advantage of the 401k is that employers do something called dollar cost averaging. They're putting the money in every month as opposed to a lump sum. So if the market's high, you're buying less. If the market's low, you're buying more shares of whatever you're investing in. Each employer that offers a 401k, they usually have investment selections that could be mid-cap, small cap, balanced funds. I mean, I'm just like terms that you hear out there, contra funds, overseas funds, international funds, whatever the case may be, tech funds, utilities funds, whatever the case is. And they have a different risk profile associated with them, where they're moderate, aggressive, conservative, etc. So you pick that, it grows, you leave your employer, you're able to do something called an IRA rollover and take that money from your employer and establish your own IRA with that and take it out of the employer plan and have it managed. Just take it away from the employer plan, because employers, just like with that employee benefit, they may change their 401k provider and may change all the options available in the 401k plan. That is their right as an owner. Now, a traditional Roth IRA has nothing to do with the employer. Here you are, you want to start saving. A traditional IRA is pre-tax. So if you make $50,000, you're putting 6,000 or 7,000, whatever the number is this year, I always forget. You put that money away. Now your income is 43,000, and your taxable income for that year is 43,000. If you have a Roth IRA, it's after tax dollars. So if you have $50,000, you put money into the Roth IRA, that's 7,000. I honestly do not remember what the number is, so I really don't. So you put that money in, you put that money into the retirement, you go do your taxes, your income's $50,000, but you have money in a Roth IRA, after tax dollars, gross tax deferred, and you can access it tax-free after 59 and a half. And you have no time when you need to take that out. With a traditional IRA, with an IRA rollover that's pre-tax, you can take that out without a 10% penalty at 59 and a half. You must start taking it out depending on the age at age 73 or age 75. There have been some changes to the law regarding that with the Secure Act 2.0. Depends on your date of birth, the year you were born. Whether you must start taking that money out at 73 or at 75. You can take it out after 59 and a half without a 10% penalty. However, the money that you take out is taxable income to you. We have some great, I have a great sheet that talks about it. You're limited on your Roth IRA and traditional IRA based on your income. There are income levels that if you as a single or as a joint, if you earn above a certain number, then you may not be able to do a deductible traditional IRA, but you can do a non-deductible one. And mostly people would do and you may or may not be able to do a Roth IRA, but you can do what's called a backdoor Roth, which means you take money, put it in a non-traditional IRA, a non-deductible IRA, and then you just convert it over to the Roth. So there are ways, there's some loopholes that have not been closed yet. So you have your IRAs. Any other questions?
No, thank you. This was very informative. Thank you.
So you have IRAs, mutual funds, stocks and bonds, annuities, CDs, real estate, Social Security, and employer-sponsored plans. And that's how we typically fund retirement. How am I doing on time? Social Security is shaky. It was never intended to be the only source. It was supposed to not be the only source. And the maximum benefit depends on the age a worker chooses to retire. And there is a maximum amount of money that you can earn, that if you earn more than that, that can't go into your Social Security. And this talks about 2034. Without changes by 2034, the OASI, the Social Security Trust Fund, will be depleted. So they're going to be making we don't know what they're going to be doing to keep Social Security viable. There are fewer pensions. Some of you may still have a pension. The employer's putting money away for you, and when you retire, you get money every month. The teachers are a great example. Your civil servants like fire and police, they still have pensions. The government, federal government, local governments still have pensions. In the private sector, there's been a big reduction. And this happened in the early 80s, and there's been a shift from a defined benefit plan to a defined contribution plan. And that's where we've seen an upsurge in 401ks and 403bs with company matches. So there's been a shift that it's more your responsibility or our responsibility to save for our own retirement instead of having our employer help us or do that for us. And there are limitations to how much money you can put into retirement plans. Personal assets are critical. Most people have more questions than answers when it comes to planning for retirement. How much do I need? How much do I have? How can we structure it so I don't run out of money? Where can I find the shortfall? Do I have to save more to have more? Do I have to change my standard of living so I don't run, there's all these questions. A good financial advisor can help you navigate those channels and get you to a place where you need to be. And there's always the effect of taxes. So,
Lori, we have another question coming in. Can you tell us individuals who are age 50 or over at the end of the calendar year can make up annual catch-up contributions? If there are, can you tell us how much?
I cannot tell you how much, but I can email that information to you because I always look at it so I don't say the wrong number because the numbers change. So if you have a 401k through your employer, think you put 22,000. I just don't want to give the number out how much you can put in, but then there's usually a $5,000 or $6,000 catch up that you can because you're over 50 years old. However, the question becomes, is that the smartest place to put it? And that's when someone like me can help you figure that out, because that's pre-tax dollars. And pre-tax dollars, you have to take out those required minimum distributions, and it may backfire on the back end, or it may not.
I mean,
Email, let me make a note. I can send an email out with those numbers in writing, because on what they are in 2024, if I can find them, okay?
yeah. Thank you. Also, the thing is, like, people can have a conversation with people like you, the financial planners, and figure out, like, what is the smart way to invest those funds if they really want to do that catch-up contribution, right?
Yeah, they can. I mean, yeah, I have a lot of, they can. 2024 limits for IRAs and catch-up contributions and catch-up. I will send that out. I will send that. I have everyone's emails, I think. So I will send that out.
Yeah. So another question we have is healthcare accounts. How can we use it when you are 50 or older? And can you have any information on that?
So if you have health savings accounts like HSAs, that's a great way. Put as much money into that as your employer lets you. I mean, you have to make sure you can do your other stuff too. Because when you retire from that job, you can take that with you. It can help pay for your long-term care. It can help pay for your health. For medical issues, it's pre-tax dollars. It's not taxed when you distribute it. It's a great way to save money for medical expenses in the future.
So it's a follow-up question. Can we utilize, how much money can we put in there?
I don't know. I'd have to look and see what the rules are. Your employer would know, but I can find that out.
Yeah, and another viewer is saying, if you are 65, you can't put money in HSA. Yeah, that makes sense because you don't want to stock that up as well. Another follow-up question. What is a HSA investment that comes with the account? And do you have any insight into that?
The HSA is typically, it's just like putting money into a 401k. I mean, you can be in the market or you can have it more conservative. It's just based on the individual and what the plan, the health savings account is offered by wherever you have that set up. So it just depends on what's offered where you have it set up, number one, and then number two is what is your risk?
Got it. Thank you.
I'm going to move on. We talked about traditional Roth IRAs. There's also fixed and variable annuities. I have clients that don't like to be in the market. Fortunately, annuity interest rate, fixed deferred annuity interest rates are doing very well right now. I remember when we were happy at 2.2%, and now we're 4.8, 4.9, whatever we're at for a 3-year, 5-year, 7-year. There's also stocks, and then there are variable annuities. And variable annuities have changed over the years, just like long-term care. They've become much more user-friendly in terms of access, fund selection, and different bells and whistles that they offer. And once again, just because they offer it, it may not make sense for you, so it may not be the right answer. But they do offer tax deferral, and tax deferral is important. One of the issues with CDs is you put money in a CD and it's earning 5 or 5.2 or whatever it is, but that's taxable income to you. Any growth is taxable, so you're not really earning that. But in a variable or a fixed annuity, if it's earning 5%, you're earning 5%, and there's 5% in there. So it's got that tax deferred. You do pay tax when you take a distribution, but it's a coordination between what you put in and what the growth is. And that's a calculation that's done at the time when you take the money out.
So there's a question, Laurie. So once you buy an annuity policy, can you change to a different annuity?
You can, based on a couple of factors. Different annuity carriers may have surrender charges, or, like you have to keep it so many years. So if you move it prior to 7 years, 9 years, whatever the number is, there may be a penalty for moving it early. But then after that, you can move it without an issue. You can go from annuity to annuity. You can also, while you own the annuity, there's usually a surrender-free window. It's usually 10% or 15%, or it's the gain. It just depends on the annuity carrier and what their policies look like. So if I have 100,000 in an annuity and now I have 110,000, so 10,000 is my gain, my surrender-free window may be 10, and maybe that gain. So I can roll that 10,000 into something else if I wanted to, and still not violate the surrender charge penalty for leaving the annuity early. It just depends. But there are new annuities out there that don't have surrender charges. So, we as an industry have started to listen to clients. However, problem with an annuity, if you're under 59 and a half and you have an annuity and you need to access that money, just like a 401k, there's a 10% penalty. So there's all these different little issues that need to be taken into account. And that's why it's always good to talk with someone that understands them, who gets to know you and understands you and what you're trying to do, so that you can be advised correctly. Products to consider for retirement: guaranteed income annuities, fixed deferred annuities, long-term care, and life insurance. Guaranteed income annuities, just worked with a client, he's 68. He had he actually had a pension and some other things, was receiving a certain amount of money, but he was short. He needed this much more. And we looked at all his retirement and his savings, and he got an inheritance. There's all this stuff that was going on. So we were able to take a portion of that and create an income stream for him. So we went from here to here so that other money can continue to grow in the market and his basic needs are being covered by that income stream. And then there's estate planning. Well, estate planning, you work with an estate planning attorney, and they will help put a will together. They will help with trusts. If you have a cohabitation agreement, if you're not married and living with someone, if you want to plan for minors. I'm just going to throw this out there. What I did for my children when they went away to college, I had powers of attorneys for both my kids. So because they were over 18, and if something happened to them when they were in college, nobody would talk to me as the parent because I didn't have the power of attorney because of the HIPAA rules. So I made sure I had POAs on both my children. Planning for funerals, burials, and remains, advanced directives, those power of attorneys, financial, healthcare, etc., HIPAA authorizations, and then power of attorneys. And that's page 5 in your workbook. Very, oh, shoot, I just made it bigger, so I can't get to how to get to the next page. Now you can see everything. Where am I? Estate planning. There we are. Oh, okay. So this is, if we had a crystal ball and you knew you would live a long time, buy a lifetime income product. You won't outlive your money. It dies when you do. And if you die and there's still money left, depending how you structure it, somebody can still get the money. You'll die next week, buy the biggest block of term insurance because it'll pay off. And that an investment would turn out to be golden, put every nickel you have in it. Unfortunately, we don't have crystal balls. All we can do is plan. And it's always important to make sure you have a good plan in place because we don't know what will happen. Finding the right financial tools to cover as many contingencies as possible. You don't want to lose control. You don't want to lose sleep. I had a client call me. They were losing sleep about the way their investments were. So we took a step back and we changed it. It was too risky for them. I had another client, I was telling Deepa earlier received an inheritance, and I'm looking at it, and the way it was structured was great for someone in their 90s. The investments that they were in were great for someone in their 90s, not for someone in their 60s. It didn't make sense based on this person's risk tolerance, time horizon, and objectives, but it made a lot of sense for his 95-year-old mother. So there are changes that need to be made. We need to make that right for him. But we also have to take taxes into consideration. You know, I don't want a big tax bill for this person. I don't want, you know, we don't want this. We don't, you know, so it has to be very structured and very systematic. There's no perfect place to put money. There are always trade-offs. And it just depends. Everything depends on you. And like I said, we have 3 or 5 of us sitting here looking exact same age, same money, same timeline, different ways of looking at it. We bring different ideas to the table. We have different goals, objectives. And so we would have 3 to 5 different scenarios.
Lori, can you show the estate planning or the wealth slide again? Some of our viewers want to know a few things from that slide.
I will do my best because I will do my best. I'm going to take you off screen sharing for a moment
No
because
problem.
it went a little bigger and I can't seem to close it. If I go like this. No.
So we have one more question that is asking, like, you know, how do we set up power of attorneys for the kids who are going away to college, and what is the age limit on that?
I'm going to stop sharing my screen while I answer that so I can fix this. So the way you do that, why did this get so big? The way you do that is you talk with an attorney. The attorneys are the ones that put that together. An estate planning attorney. Oh, no, I have to go back. I have to get myself to the end. You have to talk, you know, there are estate planning attorneys all around town. If you know, that can help you with that. If you need recommendations, I'd be more than happy to. I will give you 3. I am required to give you 3. So I'm just going through my slides to get to the page you want. And then they will help you put that together. Like when my children went to college, I met with an attorney and we put them together, as well as some directives for myself. And that worked out really well. Let me get back to that page.
Yeah. So while you are looking for that, I would like to tell all our viewers, if you have any questions, please do send your questions, or you can unmute yourself and ask questions while we have Lori with us. You can also send me a message on the Zoom app. You can send me a message directly to me and ask questions.
I have a question. Laurie, where are you located? She mentioned Geauga County, so I guess you're living in Ohio.
I do. I live in Ohio. I live in Geauga County, and I have an office out here, and I also have an office in Independence.
Okay, and your contact number 216-869-9985?
Yeah, 216-896-9985.
Yeah, that's right. Okay. And how are you affiliated with New York Life? Meaning
I'm a New York Life agent. I've been with New York Life. I've been in the industry 30 years, and I've been with New York Life for over 24. I'm a financial advisor through Eagle Strategies, which is a subsidiary of New York Life. It's the financial advisory arm that allows me to offer more services to clients.
So the policies, if somebody were to buy, they would be through New York Life.
They may be. Not, it depends. It depends on different factors. I always look at New York Life first. And if New York Life makes sense, yes.
Okay, thanks.
So in New York Life, is a Fortune 100 company, and we have the highest financial ratings in the marketplace. And we are very strong in a number of different product lines, including life insurance.
Yeah, I'm familiar with New York Life, so I have some stuff with them.
Perfect. Good. Made a good decision.
Thanks.
Can I move off this page now? I'm gonna take-
Just leave that page. If you have any questions, leave that page on the screen, Lori, and we can ask our viewers if they have questions. Because I know that this is one thing that everybody wants to do it, but we tend to postpone because of the nature of these decisions. So we need that courage to do that, and also have to figure out, like, how do we broach these kind of subjects with either with the family or friends, or like, understand the different components of
Right.
these.
Oh, I have another question. Long-term care,
Yes.
those are expensive, correct?
It depends. It depends on your age. It depends on your sex. You're a woman, so yes, it's going to cost more, 35 to 45% more than a man. And then it depends on your health. And then it depends on the type, how much long-term care you're purchasing. So and then what you want the contract to look like. So there's so many different factors that are involved. There's no right or wrong answer. The oldest I wrote someone long-term care insurance for was 75. The average age for triggering a contract is between 80 and 85. So if someone's purchasing it at 75, they're 5 years before when it could happen. So it costs them a lot more than if you were 50 or 55 or 45 or 60.
Can you also, for a female, can you, obviously this is an estimate, but somebody who is in their below 60s, if they're of good health, what would the cost be if it's kind of like pretty much, again, this is such a wide question, but I'm thinking more in terms of should a person then need to be in a long-term facility? So what would, without too much of bells and whistles, what would the premium be in such a situation, considering a healthy person when they go ahead and buy it, and then we'll look at if they're not so healthy, how much it would be.
You know what?
Just-
I think that I'd be more than happy to have a private discussion with you and actually look at numbers instead of guessing, because I really don't know. I mean, are we looking at, it's based on a daily benefit, and the average cost is expensive in this area, but are we looking at $200 a day, which is $6,000 a month, which is $72,000 a year? What other assets do you have that you can use for this? Are we looking at a 3-year benefit, a 6-year benefit, a 5-year benefit? Are we looking at home health care at 100% or less? You know, there's like all these different factors that go into it that there's no hard test. It's more complicated than we make it simple. I make it simple for you. But there's a lot of, in order to make something simple, sometimes it's a lot of complication on the back end that you just don't see.
Sure, yeah. Thank you.
You're welcome.
Do we have any other questions? If you don't want to come off of mute, you can directly text me, or if you want to contact Lori, you can contact her personally. You can call her. Lori, if you happen to have your contact information, could you just display that for our participants here?
Yeah, let me just, this thing got bigger again. We did that. I think it's at the end. Action is power. There you go. Plus, I think we emailed everyone and my contact information is on my email.
Yeah, I mean, since we all have here, it's easy to sometimes just take a snapshot of what they are seeing, and like, easier to come back to that number. Do we have any more questions?
session.
So Deepa, since we are not getting any more questions, do you have any questions that you would like to ask Lori? And should we close out the session?
Well, I want to thank you for having me, Mahima and Deepa. I enjoyed this. I hope I was able to bring some value to your membership.
Thank you, Laurie. It was very informative, and probably like once you give me approval, I will put this on YouTube and share it with everyone.
Great. And then if you could just send me the recording.
Yes.
Yeah.
Thank
Thank
you
you
so
all
much.
for this. Thank you all for joining this session today. We will share the recording with you. And thank you so much, Lori, for being part of our organization and conducting this session. Thank you so much.
You're welcome. Have a good evening.
You too.
Thank you all.
Thank you. Thank
Bye-bye.
you.
Thank you. Bye.
Bye-bye.
Bye-bye.
Thank you.
Thank you.